Today's market rally was not just a rebound in prices, it was a sharp repricing of one key assumption, that geopolitical stress and inflation pressure were about to intensify. Instead, investors were forced to consider the opposite possibility, that both risks may be easing at the same time. U.S. equities responded decisively. The Dow led gains, rising 1.77%, while the S&P 500 added 1.21%, and the Nasdaq climbed 1.31%. Treasury yields moved lower, with the 10-year yield falling as investors reduced inflation fears and moved back into bonds. Oil collapsed more than 7%, gold rose to fresh highs, Bitcoin advanced, and the VIX declined again. In other words, markets moved broadly into a lower stress, higher confidence posture. But the real story was not the numbers, it was the shift in expectations behind them. The dominant catalyst was the Middle East. Reports that the Strait of Hormuz remained open to commercial shipping, combined with signals that the Israel-Lebanon ceasefire was holding, dramatically reduced the probability of a near-term energy supply shock. That matters because Hormuz is one of the world's most important oil choke points. When markets feared disruption, oil surged and inflation anxiety followed. Today, that risk premium was rapidly unwound. As oil prices fell, investors immediately recalculated what cheaper energy could mean. Lower fuel costs can ease pressure on consumers, improve corporate margins, and reduce short-term inflation fears. That helps explain why consumer discretionary and industrials were among the strongest sectors of the day. Markets were effectively pricing in a more favorable growth backdrop. At the same time, falling yields supported technology and other duration-sensitive assets. When bond yields decline, future earnings become more valuable in present terms, which often benefits large growth companies. That is why today's rally was broad rather than concentrated. Corporate results also reinforced the move. Financials showed resilience, cyclical names delivered constructive signals, and prior strength in semiconductor demand continued to support the AI narrative. Investors interpreted these developments as evidence that the economy may be handling recent shocks better than feared. What institutional money appeared to do today was rotate aggressively. Capital moved out of defensive energy exposure and into sectors tied to domestic growth, consumer spending, and long-duration earnings streams. Real estate and financials also benefited from the drop in yields. This type of move usually reflects improving confidence, but also urgency. When a crowded hedge suddenly unwinds, repositioning can be fast. One interesting debate investors are having right now is whether today's rally reflects a genuine improvement in fundamentals or simply the removal of an extreme geopolitical risk premium. I'd be curious how you see that developing. Feel free to share your view in the comments. Even with today's optimism, some fragility remains beneath the surface. First, the market is assuming diplomatic progress continues. If ceasefire conditions weaken or shipping risks return, oil could reprice quickly. Second, leadership remains concentrated in areas like mega-cap technology and AI-linked names, where expectations are already elevated. Third, inflation has eased at the margin through energy prices, but that does not necessarily resolve broader price pressures across the economy. So the bigger macro signal may be this: markets are willing to reward growth again, but only when external risks appear contained. Confidence is returning, yet it still depends heavily on variables outside the economy itself. Looking ahead, investors will be watching whether the ceasefire remains intact, whether U.S.-Iran negotiations progress, and whether upcoming earnings from major technology companies validate the current optimism around AI spending and corporate demand. Those events may matter more than today's rally itself. The broader takeaway from today's market reaction is that investors may be reassessing how resilient growth can look when external risks start to fade. But markets rarely move on a single narrative, and today's relief move will still need confirmation. If you enjoy this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. Thank you for spending a few minutes here today. I appreciate you being part of the channel.